Welcome back to the Global Thinking Podcast. I'm your host, Rob Duncan. Today, joined by Four Strong's lead portfolio manager, David Kletz. David, welcome back to the show. How's it going today?
Thanks for having me, Rob. It's quite the day today. Halloween, we have Game 6 of the World Series, so lots going on outside of financial markets and inside them.
Yeah, be careful. This could turn into a full-blown baseball podcast real fast. I mean, this is 32 years in the making, and my goodness, Toronto is certainly buzzing with what's happening for the World Series today.
Well, I mean, if it turns into that, there's probably better candidates on the four-strong team to be talking to today. I'm admittedly a bit of a bandwagon hopper once they made the playoffs, but regardless, exciting nonetheless. Anytime a Toronto team makes it this far into the playoffs.
Absolutely. This is unheard of, 32 years. All right, well, let's jump into what we're here for. We're going to be talking a little bit about markets, providing a bit of an update for investors, for clients, for listeners. There's a few topics we're going to jump on, talk a little bit about rate cuts that just happened this week, what that means, how markets reacted to them. We'll talk a little bit about what's going on in Asia, Japan specifically, and some of the recent summit highlights that are happening then. But of course, investment implications, what this means for investor, how we're positioning. With that though, like, can you just give us like a 60 to 90-second summary, like just generally what is going on in markets right now? If you can kind of distill it down for listeners that's brought us to this point, maybe walk us through the last couple of months to kind of where we are, and then we can dig into kind of what we're watching going forward.
Yeah, well, I mean, from a risk asset standpoint and equity market standpoint, it's kind of been a tale of 2 years. Um, we obviously had the tariff shock earlier in the year in early April, the so-called Liberation Day. And then it's been a totally different story in the recovery period since, where we've made up all the losses and then some. We also had the year start off with international equities in Europe and Asia really strong, and that actually has generally continued throughout the year, outpacing the U.S. But the U.S. has had a good run here as well, post Liberation Day, with uh, you know AI centric investment themes, continuing their run of very strong performance and capturing the imagination of investors. I mean, one of the interesting things more recently that's helped propel some of that is also somewhat of a pause for concern has become the circularity of investment amongst some of the bigger players in the U.S. With OpenAI seemingly announcing a new deal on on a new multi-billion-dollar deal on somewhat of a weekly basis at this point. So that increases the risks when these firms become each other's like dominant customers and things like that, and gives some deja vu back to the late 1990s sort of environment. But that being said, in the time being, it's actually helped propel a number of companies, and any announcement from a company that has reference to AI in it seems to get really rewarded in the markets. We had Qualcomm in the States come out the other day with the announcement of the development of an AI chip to try to compete with NVIDIA, and their shares are up like 11% on the day, sort of thing. So that's been really interesting. The other side of it, on a more negative note, so I mean, in the U.S., we have had some patchy data, both because the government is shut down and we're not getting data, but also in terms of how resilient the U.S. economy is. And thus far, it's been very resilient. But we've had a softening labor market, which has got a lot of attention, and perhaps is one of the main reasons why we started to see rate cuts from the Federal Reserve. But on a very recent basis, we've had some troubling developments out of private credit, as well as the banking system. And I actually just wrote my monthly strategy dashboard piece and recorded a video on this as well. So I'll give you just the Cole's notes. I won't jump into it too deeply. But we had two private companies in different segments of the U.S. automotive industry go under for differing reasons. And then the very next week, we had quarterly bank earnings start, and we had three firms disclose pretty sizable credit write-offs for varying reasons, and actually one of them being tied to one of the aforementioned automotive companies as well. So none of them individually are really that much pause for concern. Like, yes, they were large charge-offs, and the bankruptcies are eye-opening. But when you have such a cluster of events all together, I think everyone's collective spidey sense, for lack of a better word, starts firing, and it kind of brings back memories of 2023 when we had the Silicon Valley banking crisis, which was very different than this. But when you had, varying companies come out all at the same time with troubling reports, I think that's what prompts investors to be kind of more in the mood of sell right now and ask some questions when the dust settles, so to speak. But anyways, that seems to be ancient history. I mean, markets move so fast these days. There's so much information flow, whether it be geopolitical, and we'll get into some of this later. But we've kind of made it over that stumble of the past few weeks in the U.S. banking sector, and markets are back to being strong again, particularly enabled by additional rate cuts by central banks. So yeah, it's been a whirlwind of a year, but with some positive developments here that we'll talk about later. I think we're setting up for what hopefully could be a Santa Claus rally into the end of 2025.
That's a really good summary. And again, I think to remind a lot of folks, the Liberation Day in April, which saw 20 to 25% drawdowns for U.S. stock markets, all that has recovered and more. And so people are kind of quoting this rally off the bottom as the U.S. is up 35+%, but realistically they're up, $10 to $15 and sorry, 10 to 15% in CAD dollar terms. The markets so far that are leading in terms of total return year to date, I believe emerging markets broadly has now taken the lead somewhere in the 25%, 26%, with Canada actually second place, somewhere 23, 24%. And then international, and then followed by US. My numbers might be just off slightly, but does that sound pretty accurate to you so far?
Yeah, I mean the numbers are moving all over the place. It's been like I say volatile. I don't mean that in a negative way, but I mean on a weekly basis we're getting pretty big moves up and down, particularly for emerging markets of late as well too. That bogey that you threw out there has been changing rapidly after Trump's tour of Asia, where he was. Or sorry, after the OpenAI tour of Asia, where deals were being signed in a number of different nations, Japan, South Korea, etc. We saw massive gains in like Korea and Taiwan as example, two of the biggest countries in EM. That's kind of flipped the script on returns for the year. So yeah, but definitely, you know, the U.S. has kind of led the charge post Liberation Day, but there were superior gains that had accumulated prior to Liberation Day for international markets and emerging markets as well. Prior to that, and accordingly, those markets remain in the lead on a year-to-date basis. And another big factor helping all of this, for particularly for assets outside of the U.S., has just been the weakening U.S. dollar and a really strong liquidity environment that's encouraging risk taking.
Yeah, and so that's one of the topics we're going to talk about today: the Asian summits, or the ASEAN, which I believe. Well, let's get this acronym right. It's the Assembly of Southeastern Asian Nations.
I think you nailed it.
I nailed that one. Okay, so the Asian Summit highlights, which has seen again Donald Trump meeting with prime ministers from Japan, a lot going on with China as well as America, Taiwan, and so on and so forth. We don't need to dive too deeply into it, but could you grab a couple of highlights and kind of why this is impactful, why it's so important?
Yeah, I mean, there's a lot of speculation, particularly between the U.S. and China relationship as to what would happen at this summit. Um, it's we talk about this very frequently. It gets redundant at times, but these are the world's two largest economies, and they're clearly diverging. When you hear announcements of walkbacks of tariffs or deals and things, like, yes, that's a positive, but I mean, these are two strategic rivals whose rivalry is pretty deeply ingrained at this point. But that being said, when you're able to walk back tariffs, when you're able to keep negotiating and you know basically just communication channels open, those are very good things just from a global economic standpoint, as well as more broadly just like a humanitarian standpoint. You don't want communication channels being cut off. That's a very negative sign in general. So having, I guess, Trump had a 90-minute meeting with Xi from China, and I won't go over every single detail of what was agreed to, but essentially we're somewhere back to where we were prior to Liberation Day. You'll remember in the aftermath of Liberation Day, China was one of the very few nations to stand its ground and have like a tit for tat retaliatory spiral where tariffs got up into like the triple digits for a little while, and that just the panic that ensued from that. But yeah, things have calmed down. I think both sides made concessions where it made sense to make some concessions. Like China's been using its dominance over the rare earth metals supply chain, to its advantage, to basically, increase their leverage in negotiations with the U.S. And the U.S. has been using its technology exports, in the same sort of way. And I think both have kind of calmed down to somewhat of an equilibrium, so to speak, at this point. I mean, tough to say. We hear new tariff threats and things, on also on a weekly basis too. So hopefully this kind of fragile truce or detent, if you will hold. But the fact that they're meeting in person, and the fact that things have cooled down is certainly a positive piece of news. And I think that's one of the things that could definitely propel a Santa Claus rally, into the end of the year, because this was definitely a wild card risk, that things would get worse. And I guess I'm a little biased just being Canadian, but I was also happy to see, Mark Carney, at the summit, and he didn't get the 90 minutes with Xi. He got 30 minutes, but he's trying to restart ties, with China after a pretty frosty period, under the previous leadership. And this is really important for Canada. I mean, my belief is that we're actually currently in a technical recession in Canada. I don't know if it would be a severe one or not. My default assumption is that it wouldn't. But whether it's you check the boxes in terms of the exact definition of a numerical recession or not, we're definitely struggling. The housing market's, struggling, and I mean we've tariffs have had an outsized impact on us and Mexico relative to other nations. So we're desperately looking to kind of strengthen various facets of the Canadian economy, and one of them is this over reliance on the U.S. to take our exports. So this ASEAN summit is extremely important for Canada, and if we're able to restore some ties with the Chinese, mend some relationships with, India as well, and then also I think we already have a pretty good relationship with the Southeast Asian nations as a whole, but, continue that positive environment. That was one very important facet of what I think Carney's trying to do, to strengthen our hand, going forward. So I know this was a very North American centric view of what is a Southeast Asian summit, but I mean, those are certainly China and US is what everyone was watching, but I'm a bit guilty of some closet patriotism here, just looking at what Canada's doing on the international stage as well.
Yeah, for sure. And like we're taking this podcast kind of all directions. The U.S. tariffs are conversations every single week. What's happening? So seeing Trump walk back tariffs on China, huge. I think there was some announcements from China, on buying tens of millions of soy out of America as well. So seeing just some reciprocity between the two nations to restart, economic activity, huge, huge. And for Canada, I mean, we can talk about the Canadian tariffs or the American tariffs on Canadian companies, the impact it's having for sure. And to your point, Carney, his kind of focus for the next several years is to try and triple Canada's, output or exports, to non-American economies. So this is huge. Like, this is a very important time for these types of relationships, because you've nailed it. Canada could be in a technical recession right now. There are some challenges. There are some cracks that are showing, and we got a little bit of relief with some interest rate cuts. Now, Bank of Canada cut a quarter point. U.S. cut a quarter point. U.S. sold off a little bit when this happened. Canada actually had a pretty good day, pretty good week. We're still at record highs, for Canadian economies. Why would you say? Let's look at the U.S. on this one. Why do you think the U.S. kind of saw more turbulence, in stock markets relative to Canada on that one?
Yeah, I think that was just commentary. The expectations for the U.S., first of all, had basically priced in the rate cut. And the commentary from Powell was that December is, like the next, Fed meeting. It's not set in stone. He tried to convey a message that, um, managing expectations of the markets in regards to another rate cut. And yeah, like the expectations priced into monetary policy in the US, we've viewed as quite aggressive for a while now, particularly with inflation remaining sticky at 3% year on year. I mean, it's definitely a limiting factor. I mean, we haven't seen it accelerate, but for a central bank to be aggressively cutting into above target inflation is something that we're definitely not used to in this era. So the fact that Powell was pretty non-committal and tried to walk back some of those expectations, I think that's what really gave markets pause for concern, because a lot of pricing in other asset classes besides rates markets is based on this kind of sanguine view of quite accommodative Fed policy in the period ahead.
Yeah, and I think you just absolutely nailed it. A lot of it was commentary going forward. I think people were expecting just affirmations that there was going to be another cut this year. And I think the markets quickly went from pricing in like a 60% probability down to like 20-ish, I think, in terms of this year. So I think the trend is still there, that the expectations interest rates are going to come down. I think it's the speed at which they're going to get there. This is still now a bit more an uncertainty, and markets don't like uncertainty, obviously. All right, one more kind of hot topic, Japan. So it has been, I mean, I've been watching it closely. I don't know if anyone else has. It's been an interesting year for Japan stock market, as well as the yen, and even just their economy as a whole, with a new prime minister coming in, and I think the first female prime minister in history as well. Can you just walk us through a little bit what's going on in Japan, why this matters, and if Four Strong is currently doing anything in the portfolios?
Yeah, for sure. I mean, Japan's had a really good run this year. We actually scaled back Japanese exposure a little bit recently because it had had such a good run. We wanted to take a little bit of profits off the table. By our models, the valuations in Japan had started to look a little bit overextended. Not not nearly as bad as some other markets, but it was more along the lines of the fundamentals had not kept pace with the prices. But that doesn't take away from the Japanese story, and we're still overweight. We just decided to cash in a little bit of profit on some of those positions. And I mean, what's happening, broadly speaking, in Japan? I mean, a number of things. I think one of the interesting parts of the story is usually there's this view that the yen, the Japanese yen, and the stock market have an inverse correlation, just because Japan is so export centric that when the yen strengthens, it makes their exporters less competitive on a global scale. But it's kind of and I've made this argument before, it's an interesting situation where the yen is so undervalued. The starting point has been so undervalued after years and years of depreciation that you could actually have both rallying, both the yen appreciating and the stock market climbing in unison for quite a period of time before you started to worry about the level of the yen being a detractor from Japanese exports. And generally speaking, that's what's happened. I don't necessarily know that it's yen strength as opposed to US dollar weakness. You could probably make both arguments. It depends how you want to frame it. But um, that being said, the yen's still been strong. And part of that is due to the fact that their monetary policy is moving in the opposite direction of basically everyone else in the world. Now, it's been a glacial affair where the rates have basically more so been just stable, with a bias long term towards policy normalization and increasing rates. But that's happened at the same time as most other major central banks have been cutting and increasing accommodation. So, from an interest rate differential perspective, that's definitely helped Japan. And I mean, the interesting side of that is Japanese institutional investors, pensions, insurers, et cetera, are such massive foreign investors that even if they were to pull, a portion of their holdings back towards domestic assets with, higher yields on offer domestically, that can have a huge impact on the currency and on local markets as well. Another big facet of the story in recent years has just been a renewed, or a real big push actually, for corporate governance reforms. And we've seen this before in Japan, and they were kind of watered down and not particularly well enforced. I'm still skeptical, I must admit, because behavior patterns are very well entrenched amongst corporate Japan. But that being said, we have seen some progress towards more shareholder friendly behavior. And I do think that you got the ringing endorsement from Warren Buffett as an example. I mean, clearly things are moving in the right direction. albeit slowly. That seems to be the common denominator on all things Japan. They tend to be a glacial affair. It's a very slow moving environment. And just to touch on most recent piece of news, so a bit of political turmoil with the previous PM being effectively ousted or resigning. But as you mentioned, new PM Takaichi is seen as somewhat of a disciple of the former PM Shinzo Abe. Remember the three arrows approach. So, in favor of a high degree of accommodation, whether it be monetary, fiscal, and you name it. Um, I'm not convinced that like they have the political kind of power, just given the balance in the Japanese government between various parties to really aggressively push things through. Um, and certainly the market seemed to get quite excited about her taking the reins. But yeah, I'm not convinced that that would be a game changer, so to speak. But that being said, having someone in that position of power who does have those accommodative type leanings definitely shouldn't be viewed as a negative. So to some extent, I do understand the market's reaction there. But to me, the more interesting approach outside of government is more how aggressive the Bank of Japan can be, because I mean, for the first time in basically decades, I mean, there's been the lost decades in Japan for something like 40 years or something. Now we're finally seeing some growth momentum start to become self-reinforcing. We're seeing inflation momentum start to become self-reinforcing, and that's just something we haven't seen in a generation. So how much is that able to continue? And if the Bank of Japan can start to normalize policy, that would be a you know probably very supportive of the Japanese yen. And I think it's also, just structurally speaking, would be a great thing, because it would basically replenish the toolkit of Japanese policymakers, which has been significantly depleted because they've been so aggressive in many different facets, whether it be quantitative easing or negative rates or you name it, yield curve management, the whole acronym soup of things that the BOJ has done. So to have some options when the next downturn inevitably does come, I think would be a very strong position to start from for Japan.
Gotcha. Just realizing that this podcast has been tilted pretty heavily to both emerging and developed Asia, but very important and impactful for what's going on for global markets and for portfolios, and what could be one of the key drivers heading into this next quarter or several quarters going forward. With that, look at it. Let's wrap it up a little bit. I want to talk about a little bit about investment implications. And you did talk about a little bit of views that we are pro risk or overweight equities, thinking and hoping and expectations around a bit of a Santa Claus rally heading into the year. Can you just walk us through a very high level asset mix and then maybe get into a couple of tilts in the portfolio?
Yeah, I do think it's somewhat balanced, and we have pulled a bit closer to benchmark. As you mentioned, we are still overweight stocks, but it's almost natural after a year like this, where just kind of most risk assets have had a strong year and outpaced their underlying fundamentals, that we'd want to pull back a bit of risk. Generally, how we're approaching it is, you know, take the risk in the international side of the portfolio. So we're pretty close to benchmark on asset mix. We've underweight the U.S. for a number of reasons. Ultra concentration at the top of the market, a weakening U.S. dollar trend, a shaky looking labor market, and most recently, kind of concerns about, as I mentioned, the banks and what lurks in private credit, which has grown rapidly in recent years and actually has usurped the leveraged loan market. Private credit's now at about 1.5 or 1.6 trillion dollars in the U.S., and that's again, it's a difficult asset class to get a solid feel for, considering the different types of structures involved and the opacity of those structures. So for us, like, we're certainly not anti the U.S. And still remain the world leaders in the dominant theme of the day, which is AI. So we've kind of taken a neutral approach there, but we prefer to take our risk in Europe, in Asia, and like in China in particular, which appears to be stabilizing after a very rough period on numerous fronts. So that's kind of the approach on the equity side. On the fixed income side, I think we've slowly been leaning towards taking on a bit more duration risk. We had been, the strategy had been short duration, long credit for quite a long time. And with monetary policy now loosening, you're getting paid less at the short end of the curve, and also particularly for the U.S. market, as inflation stabilizes and growth starts to trickle a little bit lower. It does make sense to pull duration back closer to benchmark, or who knows, in the future we might even go a bit longer duration. But I don't want to get ahead of myself there. And then just lastly, I've touted emerging market debt lots of times, but this is a really good setup for emerging markets. They're showing strong growth. You have ample global liquidity, and perhaps the most important factor is that U.S. dollar risk. So it's almost double whammy for like a local currency EM debt holding. You get currency gains at the same time as you get better, solvency considerations, balance of payments, you name it. It's a weak US dollar environment, or at least an environment with a more stable US dollar than we've seen in recent years, where the path of least resistance was appreciation. That's a huge positive for those positions, and they've been doing really well, outperforming almost every other fixed income asset class that we track.
Well, that's awesome. It's a great summary. I'll do a quick circle back because we were talking about U.S. financials previously. We do have a tilt in the portfolio to U.S. banks. Has this impacted our view of maintaining or trimming that exposure at all?
That's the hot button topic right now. The good news, I mean, and I did a really deep dive on this in our research of late, and just it's been the hot topic in our investment management meetings as well, is that the large U.S. banks are in really solid health. Whereas we've seen these outsized charge-offs or credit risk bubbling in some of the smaller banks. In this most recent quarterly earnings, out of the top 13 like mega cap U.S. banks, we actually saw loan loss provision ratios decreasing in, I think it was like 10 or 11 of them. Um, Additionally, capital, they're extremely well capitalized. So we read a JP Morgan study and were able to recreate it ourselves, that there's approximately 200 billion US dollars of excess capital above the regulatory required level at the top 13 banks. And what that means is it enables more buybacks, more dividend payments, potential M&A and industry consolidation, because in our opinion, there's way too many banks in the US in general, when you consider all the
Two to three
small.
thousand or something like that. All the regionals. Yeah.
Exactly. And then also importantly, if there is some trouble that does start to flare up at the smaller banks, which tend to have some a disproportionately larger exposure to private credit, it makes it for quite a large safety net around the banking system as well too. And that's exactly what happened during the Silicon Valley bank crisis in 2023. It was the larger banks that acted as a safety net, and then also the regulators and the Treasury put kind of backstopping the industry as well too. So we're not particularly concerned about any sort of contagion risk there, just given the broad health of the industry. But we're obviously watching certain areas very closely. I mean, if we get more outsized charge-offs coming to the surface, that'll be very eye-opening for sure. And then getting a better feel for private credit, because again, it's a difficult asset class to research considering how opaque it is, and trying to figure out where the various risks lie in private credit. I think absent the concentration risk at the top of the U.S. equity market that we're concerned about, private credit's probably a close number two in terms of the risks that we're monitoring in the U.S. right now.
I think I like what you said about private credit, how it's kind of a little opaque and the structures or even who's holding them. This has been a growing asset class in the U.S. for both retail advisors and retail investors, for that matter. As these types of investments have hit very retail structures and are now everywhere. This is a very similar trend happening in Canada, the emergence of alternatives. So it's something to certainly watch out for as cracks or faults occur in that end. So with that, I'm recognizing we're about 30 minutes in here. This is almost twice as long as I wanted to go, but there's a lot to cover. There's so much to cover, and we're going to try and do these a little bit more often. We are recording in audio and video today. There's a good chance this ends up on YouTube, so This could be Four Strong's first YouTube video, and I think it was like 6 years. So if this is on YouTube, thumbs up, like, and subscribe. I think that's the commentary I have to end with there. With that, David, I want to say thanks. Good to see you. Good luck on Halloween tonight with your Pikachu and Minnie Mouse. My 2.5-year-old daughter's going out as a bunny, so I think I'll also be wearing some bunny ears on that one. And of course, Go Jays Go tonight. This is October 31st. I'm in Toronto. David, thanks. Any sign off quotes before we go?
I've just heard it's become an official formality for this year that Halloween is to end at 8 p.m. Eastern time this year only. So we'll see if we can oblige those rules. But thanks again for having me, Rob. It was a pleasure.
As always. All right. Thanks, folks. Have a good one. And thanks again to all the listeners.